What I want to do today is just watch a few more investing TikToks and try to find out, are people getting good guidance on their finances, or are people full of crap? I've got 3 to look at today. I have not viewed any of them. Let's dive in.
People who grew up rich won't tell you this, but I had to fight my way here, so I'm gonna spill all the tea. So did you know that if you start investing $75 a week from the time you are 20 years old until you're 30 for 10 years, like literally just 10 years out of your entire life, that is enough to make you financially free, like in the sense that you would never have to work for money again. And maybe you're thinking,
Okay, so I see this a lot, and it's usually well-intentioned. It's talking about compound interest and how once you get some money set aside very early on, you have multiple decades to let it compound, 3 or 4 decades, 30, 40 years, you can get $1 million set aside. And that is actually about right. You can do some incredible stuff with compound interest. Here's the problem. When people do that equation and say, oh, look, at the end of your working career, you'll have $1 million. What they keep forgetting is that $1 million is not factoring in inflation. $1 million today is not going to be $1 million worth of goods and services in 40 years. Inflation is devouring the real value of that money.
yeah, okay, Nicole, how is that possible? Because I would have only actually saved $39,000, and we all know that that's not enough to make you financially free. But because you started early enough, okay, compound interest came in, took over, did its freaking thing, and made you rich. That $39,000 turned into $64,000, and that $64,000 grew into over $1.8 million. Every extra dollar you saved would have just gotten you to financial freedom sooner. Start learning for free.
So the intent is really good. It is concerning that she didn't mention a hypothetical interest rate. So why don't we go ahead and do a real example so I could show you what she's talking about and what is a realistic interest rate and how much you actually need to set aside. She claims that after putting aside $75 and investing it properly every single week, you'll have $64,000 by the time you're 30. Let's go ahead and assume you're going to work until you're 65 years old, which is pretty darn normal. And honestly, for a lot of us millennials and Gen Z, we should be expecting to work longer than 65 years old, unless you handle your finances correctly, in which maybe you can even retire early. And let's do a pretty basic interest rate. We're going to go for about 10%. Historically, this is roughly what the S&P 500 has produced. Let's go ahead and take a peek here. So we are looking at 1.8 million. Good for her. That's exactly correct. I'm proud of her. She should have listed the interest rate, but guess what? Her math is right. As long as she actually did the proper math and got the $64,000, putting aside $75 a week, she is absolutely correct. Again, I wish to remind you all, a quick kicker here, $1.8 million is not $1.8 million. Inflation will eat away at this over the long term. Next video here, do not become a day trader. That's a great start. I like this. Day trading is one of the most inefficient ways to invest possible. It is actually mind-blowing how unbelievably dumb day trading is. Day trading makes sure that you're constantly pitting your buys and sells against professional traders. That's a dumb way to do it. You also lose tax advantages because you're holding everything in short term, while the government in the United States gives you a better tax rate when selling stock at a gain if you hold it for at least 1 year. This is called long-term capital gains. And then on top of that, you're racking up lots of fees and taxes because you pay capital gains tax when you sell something that has a gain. If you just held your investment for 100 years, you're not paying any money on that capital gain. If it's a stock that pays out dividends and it's in a non-retirement account, you'll pay taxes on that. But a lot of stock growth's gains comes from capital gains. The company's doing better over time and being worth more. You are allowed to then sit on a ton of gains over the long term and not pay taxes on it. It's a great thing. Day trading, though, is a terrible thing. Day trading forces you to realize those taxes, pay it every single year because you keep selling your investments and triggering capital gains tax, and that's horrible. Unless you're day trading in a retirement account, but then, Jesus, what are you doing? What are you doing? All right, take a look at this.
Please don't become a day trader.
Yeah?
Please. If you see people like this and think to yourself, I want to look like that, and you think day trading is a get-rich-quick scheme, you are dead wrong. I was one of those people. When I started day trading 2 years ago, I lost $2,000 in 2 months. $2,000 that I took 3 months to earn, 3 months of working 9 to 5. I don't want you to make those same mistakes. You have to approach it as a skill and a discipline if you actually want to make money in these markets. If I haven't scared you off day trading,
So, pause. Skill and discipline makes me nervous. Citing skill and discipline as important makes me nervous. Discipline is true. If you are investing in a low-cost, well-diversified index fund, you need discipline to make sure you stay on course and continue to invest. You don't really need much skill for an index fund, which is statistically the best way to invest for most people. You don't have to try to compete against professional traders and analyze stocks, just buy everything. From 2001 through 2020, only 22% of the stocks in the S&P 500 actually outperformed the index, meaning if you did your research and you just bought a random stock that you really liked, you statistically are going to underperform the index. The S&P 500's return is mostly carried by a handful of significant performers, ones that have blown everybody's mind. Think Apple, for example. Unless you feel like you're skillful enough to pick the next Apple, you're probably going to be better off just buying an index fund. Which makes me worried because the skill level to really rock in the markets and be like the next Warren Buffett is unbelievably rare. Better just be disciplined when it comes to buying market index funds.
here's what I want you to do. I'm going to be posting here every single day my journey from $100 to $1,000. I'm going to show you the tips that I've learned throughout the way, and I want you to get better at day trading with me. Join me on my journey and follow my videos. Thank you.
So basically, he's coming out here saying, I screwed up day trading originally. Let me show you how I day trade now, and I'm going to take $100 and turn it into $1,000. That's 10xing your investment. That's insane. The S&P 500, top 500 US companies, market weighted, so the bigger companies get more representation, the smaller ones get less. The S&P 500 doubles, just doubles, not 10x's, doubles every 7 or so years on average. And sometimes it doesn't double. You get into 08 and you're down and out for a little while. This guy is basically pitching the idea that he's going to take $100 and 10x it. That's like lottery level return. Most people will lose money pursuing it. His learning lesson from day trading, though, kind of is correct. You cannot make money day trading. Most people will lose. It's more akin to a casino. But there is a way to make money off of active trading or day trading in which other people pay you to do it for them, whether you're a financial advisor trading in somebody's portfolio, or whether people are paying for a course you're selling, or they're watching your different videos so you're getting ad revenue. That's how you make money day trading. You do not make money day trading privately doing it for yourself. You make it by finding ways to make money off of other people who are paying you to day trade for them or watch you do it. This guy did come to the correct conclusion, but he also came to this scummy conclusion. Instead of telling people how to not day trade and that market weighted index funds typically do better than stock picking or certainly day trading, which is highly inefficient, full of fees and taxes, his solution was, oh, I can day trade. I just need to up my gain by having people watch my videos and making money off of it or sell them a course, etc. Oh, God, finance TikTok is the worst. It's so bad. I saw this and this immediately raised a red flag for me, so I can't wait to check it out. What I did from ages 18 to 21 to save and invest $95,000. Why is there a red flag here? Well, it's pretty obvious. Most people are in college, and most people will benefit by focusing on college, maximizing their GPA, maximizing their unpaid internships, but making connections in the industry they want to go into so that they score themselves a great job. Early on, you want to get a nice salary so you can then invest a bunch and take advantage of compound interest and the fact that when you're young, your money has a lot of time value. There's a lot of time between you right now in your 20s and when you retire. You're able to let your money just double. Let that compound interest go. But this person is alleging they made $95,000 during the years where most people should be focusing on college. The only way to really save money during that period, in my opinion, that would be around $95,000, is go to a community college, is get scholarships to college. In short, cut cost. But we'll see if she goes that route. If you tell me some sketchy strategy that involves skipping your education, it's going to be bad. It's going to be bad. Let's find out whether this is a win or a disaster.
I have $95,000 saved at 22 years old, and here's exactly what I did once I turned 18. Once I turned 18, the first thing that I did was look for a job that was going to pay me a good amount of money and with good hours, right? Because my whole goal was to just make money somehow. And the start of that, a job.
Step 1, no education, no higher education, and that is a huge financial mistake. That is devastating. If we look at the earnings and unemployment rate by educational attainment back in 2021 from the Bureau of Labor Statistics, you'll see that bachelor's degrees print money compared to high school diplomas. Spending 4 years in college to get a bachelor's degree makes you, on a median basis, $1,334 a week. High school diplomas don't even get to $900. They barely even make $800. You need a degree. It's very important to get something. That doesn't mean, though, you have to spend a lot on it. Saving money and keeping your costs low is good. You can also go to trade school and get yourself on a career path that is going to pay out well. It is really important to understand that when people give you advice on don't go to college or get a higher education, they're condemning you to a life where you statistically won't make that much money. And to be blunt, the jobs that require little skill or just a high school education, they're going overseas as more countries get wealthier, as their education systems improve as time passes. What's nice here is also the Bureau of Labor Statistics put together the unemployment rate as well. So not only do people with high school diplomas make significantly less per week compared to bachelor's degrees, their unemployment rate is also significantly higher. Back in 2021, bachelor's degrees had an unemployment rate of 3.5%. High school diplomas came with an unemployment rate of 6.2%, nearly double. So not only are you making significantly less, you also have a much higher chance of being unemployed.
Once I started making a good amount of money, honestly, I left it in a checking account, and that's when my former mentor told me, don't leave it in a checking account, leave it in a high yield savings account. Hence, I took all the 25 grand that I made in that year and I left it into a high yield savings account. And with that high yield savings account, I was able to earn a good amount of interest on the money that I was getting.
So let's go ahead and raise a couple red flags here. There's a lot of good terminology, but you should also understand the amount of issues that are also coming up in this. First, what is a high yield savings account? It's a savings account that pays you a decent yield, just like other savings accounts have a bad yield. It is not something special or different. High yield savings accounts, aka a savings account that pays you something, usually are offered by different online banks. In short, if a bank has lower costs because they don't have physical locations, they give their customers a little bit of benefit to lure them in by offering a better rate of return on the savings accounts. Now, here's the deal. $25,000 is a lot of money to have in a savings account. Unless people are saving for a short-term savings goal, most people won't have a lot of cash. You might have a little bit extra in your bank account, just about $1,000, an emergency fund, 3 to 6 months of your necessary spending in case you run into an inevitable emergency, whether it's losing your job, your car breaks down, etc. And the rest of your money is probably being invested in the stock or bond market. Period. As a result, $25,000 seems like a real red flag to me. There are real problems if people are being told, shove a ton of money into a savings account. Additionally, high-yield savings accounts can struggle to keep up with inflation, meaning your $25,000 is losing purchasing power even though the number is going up. 2 questions from chat. Is there a high-yield savings account? As well as, does a high-yield savings account hit you with more fees if you take the money out? First, a high-yield savings account is just a savings account that pays you a high yield. It is not anything different than a normal savings account. But where they're getting the extra money from is because less services are offered, particularly the lack of a physical location. For example, I bank with Ally. Full disclaimer, I'm not paid by them. This is just my bank account and I really like it. It may or may not be good for you. But Ally is an online-only bank. And even because they don't have these physical locations, the cost to run the business is a lot lower. That means they can offer me a 3.6% yield. Mind you, keep this in mind, this does change. If interest rates go up, they typically increase their yield, and if the Federal Reserve cuts their interest rates, I expect this to go way down. It changes with the market. Now, what doesn't change with the market, typically speaking, is your standard corporate bank like Bank of America, Wells Fargo, and Chase. These are companies that offer you absolute garbage on your savings accounts, and they even sometimes come with additional monthly maintenance fees. The benefit that each of these firms offers, though, is they are these giant banks of all these luxury services and tons of physical locations. So you have a choice to make. Do you want a physical bank or not? If you don't want one, go find an online bank that offers you a savings account with a high yield, aka a high yield savings account. Likewise, if you want a physical location, screw these corporate banks. Wells Fargo, Chase, Bank of America are absolute trash. Go find a local credit union. This is a non-profit that operates as a bank, but all the people who deposit money there own it, and you'll run into much less fees. You probably won't have a good savings account interest rate, but you're less likely to get screwed because you're skipping out on corporate America and the big banks, and you're leaning into a non-profit for your physical banking needs.
So it was pretty great. Once I turned 19 is when I officially started investing, and that's when I opened up my Roth IRA, which is a tax-sheltered retirement account. And essentially, I would invest into index funds that track the S&P 500, which has an annual return of 8 to 10%. So I would invest into index funds like VU, SPY, and also a few bonds like BND. And
all right, good so far. Good so far. Quick thing: VU and SPY, they're both S&P 500 index funds, even though they have different tickers. They're going to track the same index, so their performance is going to be very similar. SPY is the S&P 500 ETF offered by State Street, and likewise, VU is the S&P 500 ETF offered by Vanguard. With that said, though, there is not just a difference in terms of the provider, but there's also a difference in fees. You should double check this, but last time I checked, VU from Vanguard has lower fees than SPY. State Street actually created another S&P 500 ETF with similar fees to VU, so they could compete better. So do your research before buying one of these S&P 500 ETFs. Make sure you find a reliable brand that has a low expense ratio.
for anyone that doesn't know, index funds are a basket of stocks, and it's a lot safer than investing into an individual stock, because you don't know if that individual stock would do well, as opposed to investing into like a bunch of companies, right, that are like well-known and reputable. Not to mention, I also moved out when I was 19 years old because I just didn't want to stay with my parents anymore, and I thought they were super toxic. But if you can stay with your parents all you want, because that will save you a lot of money in the long run. And
That's true. That's true. In terms of, you have to value your mental health, but if you're able to live at home, it's an insane jump in your finances. It's mind-blowing how much you can bank of your salary if you don't have to pay rent. Rent is often 25 to 30%, if not more, of your monthly paycheck, particularly when you're starting out, because you don't have a bunch of raises that have accrued over time. You're starting with a low salary relative to your potential salary, and your rent is still chunky. It's a big chunky of your, your rent's chunky. I don't know what else to say. Your rent's chunky. It's a fat rent. Let's see here. So basically, in short, if you can live at home and save your money from rent, you're going to do great. Now, obviously, if the cost is your mental health, you should make some tough choices. It's not easy. But if you get that advantage, it's a wonderful thing.
I still go to my parents for food all the time because that saves me money. Once I turned 20, things really started picking up for me because I had gotten my promotion as assistant manager at the 99 Cent Store that I had worked at ever since I was 18 years old. So I was getting 20 plus hours of overtime on top of the second job that I had, which was a security guard at Louis Vuitton. So any money that I would be making, I literally would either use it for rent or for my expenses, and whatever leftover I had, I would spend that.
So I'm glad she brought up her job, because truth be told, if you went to college or to a trade school and had a particular career in mind, even though you spend 4 years doing that, you'll probably be starting out with a much better salary. And early on, when you're trying to build wealth, it's a lot more about getting a good salary and banking a ton of it than it is getting a jump start at a low salary. You only lose out in the investing world if you start a decade late. If you spend 4 years locking in a great salary by getting a higher education and then putting yourself on a great career path, you can quickly catch up to the people who started at age 18 and started aggressively investing. Because early on, that compound interest snowball hasn't begun. The first doubling on an investment that makes 10% takes about 7 years. You can catch up. So I really want to stress for people, if you don't go to college, you need a very good reason. You need a very good reason. You need to know that you're going to trade school. You got an apprenticeship. You know you have a career path that requires a different set of skills that you can't acquire at college. And it has to be a great career path. And maybe you're going to sales. Maybe you're going to computer programming. I don't care. But ultimately, you need a reason to not pursue higher education. That doesn't mean go spend $200,000 on an art degree. That's not what you should be doing. You should be trying to get a low-cost education, either tied to a career you want. Maybe you want to go become a civil engineer. And if you don't have something in mind, make sure it's very low cost so that you can quickly enter the workforce, have a 4-year degree there, and then pursue a lucrative career because more opportunities will be available to you because you have a degree than to somebody who just has a high school degree.
On just, investing and also putting that into my high yield savings account. Once I turned 21, I was on track to becoming a store manager, and I actually almost got the position, but I ended up getting fired like 2 weeks later because I was dating my former coworker at the time, who is now my ex, who ended up cheating on me, and just basically I got fired. It's a long story, but besides the point, I had to start back from scratch, work my way up towards Aldi's, which is the job I have right now, towards becoming an ASM, and I
quickly want to give a little tip of the hat in terms of she's clearly a hustler. She gets the job done. I am critiquing the TikTok for the average person, but I do want to give a quick hats off to her. She makes moves. She's a hard worker. She will probably find some success in life, but she is taking the hard road here. She's not taking the straightforward path towards success. She's going out of her way to struggle more. And look, I don't know if she actually had the opportunity for higher education or not, but do not hear this and be like, I need to take the hard path. The hard path is more likely to give you worse results long term.
Work at Walmart too, like you all know. But yeah, so the journey to me saving money honestly just had to do with working a lot and using that money to pay for just expenses, budgeting properly, and then whatever leftover I had, I would just be investing that money, and yeah.
All right, my overall rating is a thumbs up. Now, you might be expecting me to give it a thumbs down, but honestly, I admire the hustle. I admire the intent. Here is somebody who didn't go to college, who is doing all the right things to build wealth if you don't have access to higher education. And for some people, that's going to be really important to see. Seeing somebody who isn't going to college and how they're building wealth is really eye-opening, because it tells you how much easier it is if you go to college and just go for a standard career path, as opposed to foregoing college and doing your best. She's juggling multiple jobs. She's having to learn lessons the hard way. And she is probably just trying to get by day in and day out and bank as much as she can. Her salaries can't be that great. She is spending her time working, not enjoying life. And that is fine. I actually have, again, a lot of respect for that. But I hope ultimately this opens people's eyes to what it's like if you don't go to college. Or if you don't go to trade school. If you don't get an apprenticeship and you just try to say, you know what, I'm going to go out, get what job I can, and try to work my way up at an Aldi's or some kind of food store, etc. It is not easy, and she has my respect. Overall, investing TikTok continues to be an interesting adventure. If you enjoyed this, give it a thumbs up, hit subscribe, and I'll see you beautiful people in the next video.